What if the number your portfolio app calls risk is measuring the wrong thing? Open almost any finance textbook, risk model, or robo-advisor dashboard, and you will see the same substitution. Risk equals volatility. The higher the standard deviation of returns, the riskier the investment looks. That idea is so common, it feels like a law of nature. It is not. It is a modeling choice that got promoted into a definition. Risk is not volatility. Standard deviation can be a useful statistic. It is a terrible full definition of what can actually hurt you as an investor. Confusing the two is how people sell safe strategies that still blow up and fear risky ones that simply bounce. Standard deviation, sigma, measures how widely outcomes spread around the average. In markets, it usually comes from historical returns. High sigma means the path was choppy. Low sigma means the path was relatively smooth. That is all it claims to measure. Dispersion, not safety, not survival, not whether you still own the asset when the recovery arrives. Here is the quiet error. Investors care about permanent loss, ruin, and missing a life goal. Finance software needs a number that is easy to compute and rank, so the industry swapped the hard human problem for a convenient proxy, price wiggle, and then started calling the proxy risk. Once the label sticks, people optimize the label. Smoother lines get rewarded, choppy compounding gets punished. Temporary mark-to-market pain is not the same as permanent capital loss. A quote that falls 50% and later recovers is a rough ride. A business that never recovers, a forced sale at the bottom, or a leveraged blow-up that ends the game. Those are different animals. Volatility treats every move as if it were the same kind of danger. Your bank account does not. The arithmetic is unforgiving. Lose 50% and you need a 100% gain just to get back to even. Lose 30% and you need about 43% back. Lose 20% and you still need 25% just to climb out. A single number for volatility hides how deep holes demand disproportionate recoveries, and how sequence can make the hold permanent if you sell. Standard deviation is symmetric. A stock that rockets higher raises its measured risk, the same way a stock that collapses does. For a long-term owner, upside variance is often the point of owning equities. Treating all dispersion as bad trains people to fear the outcomes that create wealth. It also flatters strategies that suppress upside in the name of looking calm. Real markets are not neat Gaussian bells. Return distributions have fat tails. Extreme moves happen more often than a normal curve implies. Left tail events, crashes, freezes, blow-ups, can dominate long-run results for fragile strategies. A calm recent sigma can coexist with catastrophic hidden risk, especially when leverage, illiquidity, or short options are doing the quiet work underneath. Two portfolios can share the same average return and the same volatility, yet produce very different lived outcomes. Order matters. If you are withdrawing money in retirement, a bad sequence of early losses can permanently shrink what your plan can support, even when the long-run average still looks fine on a slide. The spreadsheet average is not the life you live month by month. Volatility becomes real risk when it forces your hand. Margin calls, job loss plus a market crash, a fund that gates redemptions, a strategy you abandon after 3 ugly years, right before it works again. The danger is not only the wiggle, it is whether the wiggle can push you into a permanent mistake you cannot reverse. So why did finance adopt volatility anyway? Mean variance portfolio theory, CAPM, and decades of software made sigma the lingua franca. It is computable, comparable, and plugs cleanly into optimization. That institutional convenience is powerful. It is still not proof that one statistic equals risk for a human with a finite life, a job, a mortgage, and a plan. None of this means volatility is useless. For sizing related positions, comparing similar assets, or pricing options, dispersion can be a valuable input. Risk managers use it every day for a reason. The critique is substitution, calling sigma risk, stopping there, and optimizing only for a smoother line, as if smoothness were the same as safety. Better questions sound different. What is the permanent loss scenario? And how would I be forced into it? What does the left tail look like under stress, not just the recent sigma? How much leverage, illiquidity, and concentration am I really carrying? Those answers rarely fit on one dashboard badge. And the most personal question, does this risk measure match my actual goal? Retirement income, a house, runway for a business, or only a spreadsheet ranking? A smooth strategy that fails your goal is riskier for you than a choppy one that still gets you there. Risk is personal because goals are personal. Different horizons need different risk language. A day trader, a pension fund, and a young accumulator are not solving the same problem. Be suspicious of any single number that claims to settle the debate for everyone. When someone says low risk, always ask, low risk of what? Over what horizon? For whom? Volatility measures how much the path bounced. Risk asks whether you can survive the path and still reached the destination. Remember 3 things. Risk is permanent loss, ruin, or goal failure, not mere price wiggle. Standard deviation is a symmetric dispersion metric. It can punish upside and miss fat left tails. Ask better questions about leverage, liquidity, forced selling, and whether you can hold through the path. And just to be clear, this is education, not financial advice.